Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of interest rate risk. Protect your investments from market shifts. Factors influencing interest rate risk. Economic indicators impacting interest rates. Economic indicators play a crucial role in influencing interest rates. Factors such as inflation rates, GDP growth, and employment levels can impact the movement of interest rates. For example, if inflation is high, central banks may decide to increase interest rates to control inflation. On the other hand, low inflation rates may lead to lower interest rates to stimulate economic growth. Understanding these economic indicators can help investors gauge the potential impact on their investments. Central bank policies and interest rate movements. Central banks, such as the Federal Reserve in the United States or the European Central Bank, have a significant influence on interest rates through their monetary policies. Central banks may raise or lower interest rates to achieve specific economic goals, such as controlling inflation or boosting economic activity. Investors closely monitor central bank statements and decisions to anticipate interest rate movements and adjust their investment strategies accordingly. Global events and geopolitical risks. Global events and geopolitical risks can also impact interest rates and introduce uncertainty into the market. Events such as trade disputes, geopolitical tensions, or natural disasters can create volatility in financial markets, leading to fluctuations in interest rates. Investors need to stay informed about global developments and assess the potential risks to their investments. Geopolitical stability plays a vital role in shaping interest rate trends, making it essential for investors to consider these factors when managing their portfolios. In a dynamic economic environment, understanding the various factors that influence interest rate risk is crucial for investors to make informed decisions and navigate market fluctuations effectively. By staying informed about economic indicators and market trends, investors can better position their portfolios to mitigate the impact of interest rate changes and achieve their financial goals. Case studies on interest rate risk management. Interest rate risk management is crucial for investors to safeguard their portfolios. Analyzing real-life examples can provide valuable insights into successful strategies and the challenges often faced in implementing them. Real-life examples of successful interest rate risk mitigation. In one case study, a diversified investment portfolio faced potential losses due to rising interest rates. By strategically allocating a portion of funds into floating-rate investments, the investor was able to offset the negative impact of interest rate hikes. This proactive approach not only protected the portfolio but also resulted in increased returns during periods of economic uncertainty. Another example demonstrates the effectiveness of interest rate swaps in managing risk. A corporate entity utilized interest rate swaps to exchange variable interest payments for fixed rate payments, effectively hedging against interest rate fluctuations. This strategic move not only stabilized cash flows but also provided financial predictability in a volatile market environment. Challenges faced in implementing interest rate risk strategies. Despite the potential benefits, implementing interest rate risk strategies comes with its set of challenges. One common obstacle is accurately predicting interest rate movements, as market dynamics are influenced by various economic factors. This uncertainty can make it challenging for investors to time their risk mitigation strategies effectively. Moreover, regulatory constraints and compliance requirements add another layer of complexity to managing interest rate risk. Navigating the regulatory landscape while aligning risk management practices with legal guidelines demands a thorough understanding of financial regulations and an adaptive approach to compliance. While real-life case studies illustrate the positive outcomes of interest rate risk management, it is essential for investors to be aware of the challenges inherent in implementing these strategies. By learning from successful examples and understanding the obstacles faced, investors can make informed decisions to protect their investments against interest rate fluctuations. In this video, we've delved into the concept of interest rate risk and how it can impact your investments. By understanding how changes in interest rates affect the value of your investment portfolio, you can make more informed decisions to mitigate potential risks and seize opportunities. Remember, diversification is key to spread risk across different investment types, sectors, and asset classes. Stay informed about economic indicators and market trends to stay ahead in managing interest rate risk. Your financial journey is unique, so tailor your investment strategy to align with your risk tolerance and long-term goals. Stay proactive, stay informed, and stay empowered in navigating the dynamic landscape of investment opportunities. Interest rate risk is an essential factor to consider in investment management, as fluctuations in interest rates can significantly influence the value of various financial assets. Understanding and mitigating this risk can help protect your portfolio from adverse market shifts and ensure more stable returns over time. Interest rate risk predominantly affects fixed income securities such as bonds. When interest rates rise, the price of existing bonds usually falls because new bonds are issued at higher yields, making the older, lower-yielding bonds less appealing to investors. Conversely, when interest rates decline, existing bonds with higher yields become more attractive, driving up their prices. This inverse relationship between bond prices and interest rates means that investors holding long-term bonds are particularly vulnerable to interest rate risk. To manage this risk, one effective strategy is bond laddering, which involves purchasing bonds with varying maturities. This approach spreads the interest rate risk across different time periods, reducing the impact of rate changes on the overall portfolio. As shorter-term bonds mature, the proceeds can be reinvested in new bonds at current interest rates, potentially enhancing returns and maintaining a balance between risk and reward. Another strategy involves investing in floating-rate bonds. Unlike fixed-rate bonds, the interest payments on floating-rate bonds adjust periodically based on a reference interest rate, such as the LIBOR or the federal funds rate. This adjustment mechanism helps protect investors from interest rate risk, as the bond's yield increases in line with rising interest rates. Equities are also affected by interest rate changes, albeit differently from bonds. Higher interest rates can increase borrowing costs for companies, potentially reducing their profitability and, consequently, their stock prices. Moreover, higher rates can make fixed income investments more attractive relative to stocks, leading to a shift in investor preference. Conversely, lower interest rates tend to stimulate economic growth and corporate earnings, which can boost stock prices. To mitigate interest rate risk within an equity portfolio, investors can focus on sectors that are less sensitive to interest rate fluctuations. Defensive sectors such as utilities, consumer staples, and healthcare tend to be more resilient during periods of rising rates because they provide essential goods and services with consistent demand. Additionally, companies with strong balance sheets and minimal debt are better positioned to weather the increased borrowing costs associated with higher interest rates. Real estate investments, including real estate investment trusts, REITs, are also subject to interest rate risk. Rising interest rates can lead to higher mortgage rates, which may dampen real estate activity and affect the profitability of REITs. However, real estate can serve as a hedge against inflation, often accompanying periods of rising interest rates. Diversifying real estate holdings across different property types and geographic regions can help mitigate the impact of interest rate fluctuations. Additionally, investors can explore alternative assets like precious metals, cryptocurrencies, and inflation-linked securities to diversify their portfolios further. Precious metals, such as gold and silver, have historically served as stores of value during inflationary periods, providing a hedge against currency depreciation. Cryptocurrencies like Bitcoin offer decentralized and inflation-resistant assets that can complement traditional investments. Inflation-linked securities, such as Treasury inflation-protected securities, TIPS, provide guaranteed returns that adjust with inflation, ensuring that investors maintain purchasing power over time. Incorporating these alternative assets can enhance portfolio resilience and mitigate the impact of interest rate risk on investments. One of the most effective ways to protect your finances from inflation is through prudent investing. Investments that historically outpace inflation, such as stocks, real estate, and commodities, can help maintain and grow the value of your assets. Holding cash and cash equivalents, such as money market funds and short-term certificates of deposit, CDs, is another way to manage interest rate risk. While these assets typically offer lower returns compared to other investments, they provide liquidity and stability, allowing investors to seize opportunities that may arise during market shifts. Financial derivatives, such as interest rate swaps and options, can also be employed to hedge against interest rate risk. These instruments allow investors to lock in current interest rates or benefit from future rate changes, providing a layer of protection against adverse movements. However, derivatives can be complex and require a thorough understanding of financial markets, so consulting with a financial advisor is recommended before incorporating them into your investment strategy. In summary, protecting your investments from interest rate risk involves a combination of strategies, including diversifying fixed income investments through bond laddering, incorporating floating rate bonds, focusing on less interest rate sensitive equity sectors, diversifying real estate holdings, maintaining liquidity with cash equivalents, and potentially using financial derivatives. By implementing these approaches, investors can better navigate the challenges posed by interest rate fluctuations and safeguard their portfolios from market volatility. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.